Hello and welcome to Blockchain Silver, the place where we analyze what in the world is going on in crypto. Today we are going to talk about Elliot Wave and the Dow Jones Industrial Average. Warning, I'm not a financial advisor. This video is for fun and entertainment purposes only. It is best to do your own due diligence, form your own conclusions, and invest based on your opinion of the market. Cryptocurrency markets are highly speculative and may lose value. Be safe out there. So I had a viewer that asked, can you do an Elliot Wave video on the Dow Jones? Yes, I can. This is actually a video that I've been thinking about for probably about the last month or so. And so this was a good time to get one done. And also I want to add, this is a cryptocurrency channel. Today we're going to talk about the Dow. We won't be talking about crypto much. So if you are interested in hearing about crypto, then it's not going to get mentioned much here, so I don't want to waste your time on watching the whole video. But so anyways, let's get started. So PA93 is wondering, I think we're about to hit a super cycle top in a couple of years. Now, based in dollars, yes, we are higher than these last two cycle highs. But I'm going to show you here in this video why I think the year 2000, 99, 2000, 2001, that this was actually in value. This is where the dollars got the most bang for their buck. And here, so this here is about 11,000. If you see 10,000 here, this was about 11,000. This here is 27,000. So 11,000 times 2 is 2,000. Add another half of that. Over the last 20 years, it's up about 250% or 2.5 times. But it has taken a ton of money to get up to this point. And so the short answer is Elliot Wave on the Dow. I'll give you this is just my opinion. You could look at this two ways. This being a cycle 5 with an A, B, C correction, and then a brand new wave 1 with probably coming into a wave 2 here over the next 4 or 5 years. Or you can look at this in value terms with this being a wave 5 with an A, B, C correction. And I see that across the board with everything. Cycle wave 5 with an A, B, C. Brand new wave 1 with probably a 2 starting soon. And the NASDAQ is the only one where it's kind of similar, but it's kind of different. Now the NASDAQ, this is all technology and internet stuff, internet stocks. This is your 500 most highly traded companies, usually the Fortune 500 companies, but it's also the 500 most traded. And then Dow is these are 30 of your top stocks here. So all of these are different, but now the NASDAQ, to me, I'm more bullish on this one than I am, but they all will probably do something similar. The NASDAQ is actually up the least, if you noticed, 150% versus 200 on the S&P, 250 on the Dow. But that's because this was overly high in 2000. This was about 5,500, I believe, was its high. Today it's trading at 82, 81. And so same thing you could look at an A, B, C correction with a brand new 1 coming into a 2. Or you could look at it like an A, B with a C correction. But most likely all of these, I would say I feel just in dollar terms, we're coming into a 2, but in value, we're coming into a C is what I believe. And I'm more of a value investor than just a dollar-based investor. And so let's get into why. Let me show you why I think this. So over in the year 2000, we only had 5.6 trillion. Yeah, I know, only 5.6 trillion in national debt. Well, in 2019, we have 22 trillion. So this is about 400% higher. So national debt has actually outpaced everything. So if you get what I'm saying here, all this stuff is only up 150, 200, 250%. But national debt is up almost 400%. It has actually outpaced everything in the economy. So by investing in any of these, would we really be up anything? Well, you would if you bought in 09, if you bought in these peaks, you know, buy low, sell high. That's what everybody wants to do. And that's really what you have to do as an investor. You have to buy low or sell high, or else it won't be long and you will be in bankruptcy, or your portfolio will be down to zero. If you buy here and sell here, you didn't make anything. And so what this is causing, this national debt and all these bailouts and this Fed money and Fed printing and 2008, 2009 housing crisis, all this stuff is overinflating the debt markets. And so there's a lot of debt out there that's floating around that I don't know what it's going to do when the day comes where it comes home to roost, but there is a day where this is coming. And so the two things that I look at are food right here and fuel. Now, I'll agree this is definitely not the best thing to use. This is the Big Mac index. But all I'm looking at, the green is the federal CPI, which is the consumer price index. They take a basket of goods and they compare it against year over year. The blue line is the Big Mac index. This is what a Big Mac cost from 1986 to 2016. And we see here in the year 2000, it's about probably about $2.25 or $2.50. And now in 2016, which it doesn't even have 2019, but it's probably somewhere around $5. And so essentially food has doubled. Now, I would never use just one piece of data to cover a whole thing of food. I should have put probably 5 or 6 in here, but I want to keep this video short, hopefully between 10 and 20 minutes. But, you know, food the Big Mac, let's just say the Big Mac has doubled in price. So if your portfolio, if it's doubled in value, which the NASDAQ wouldn't even have done that, the national debt definitely. NASDAQ hasn't. The S&P has kept up with food. Dow Jones has beat it just a little bit, but debt has went way higher than food. And so now let's look at fuel. So I keep an eye. I watch food and fuel like a hawk. I don't watch it daily, but I watch it closely. And so in the year 2000, this is retail gasoline price, $1.50, and this would be the constant. This would probably be inflation adjusted for today, but I pulled today, 10/31/2019, and this is AAA. They're saying about 261 from 151, and so this is pretty darn close. I think it's right around where I live. I live in Michigan, in the U.S. I live in the United States, state of Michigan, and I want to say it's, you know, it varies by what city you're in, but it's about $2.40 to $2.50 a gallon, and so it's almost double. So food and fuel have almost doubled, or you could say Big Macs and fuel have almost doubled, while everything else other than national debt has went higher. And so what I'm getting at here, so based on value, let's just say you had a ton of money or just money. It doesn't matter whether you have a ton or a little bit in the Dow. You're not really up anything. It's just kind of keeping up with inflation. It's not really performing like it should, like a portfolio should. And so that's why I'm actually extremely bullish on cryptocurrencies, because in the last 10 years, they've done well. Also, if you just look at the last 10 years, counting this as an ABC and a brand new wave one, the NASDAQ on that, 1,500 to 8,000, it's actually done the best. That's about what, a 4 or 5x increase for just from here to here. And from the S&P 900, that's about maybe a 3x, maybe a little lower. It could be close to the NASDAQ. And then the Dow, if it was at maybe 9,000, maybe about a 3x. So they've all kind of kept par with one another. But now let's take a look at real median household income. In the year 2000, it was about 61,000. We've gone now 20 years, and wages, if you ever hear economists talk about stagnant wages or stagnant wage growth, this is what they're talking about. 18, 19 years across, it's only up a little bit, and most of that's happened just in the last few years. And because I believe that we are in an inflationary cycle now. There's another cycle out there that I should have put on here, but it's like a 8-year inflationary deflationary cycle. And it kind of goes something like this, where you go roughly about 8 years deflationary, 8 years inflationary. And so 2000 to 2008 deflationary, 2016 inflationary. So could we go back into a deflationary cycle? I don't know yet. Time will tell. But with this here at 61,000, real median household income really hasn't done anything. It hasn't done a darn thing. And so food has doubled. Big Macs have doubled, but wages have not. Compared to 2000, wages should be up to about $120,000, and that's just not happening. And so really what's going to happen in all of this? I see cryptos doing well for about the next year into 2020, but then after that I see silver and gold doing extremely well. And so there is a thing called the Dow to gold ratio. When gold gets up here versus the Dow, gold is cheap, gold is expensive. Gold is cheap, gold is expensive. Gold is cheap, gold is expensive. I see silver and gold, just like in the 70s, how it went like this here. I see something similar if you compare this to this, where we've came down, went up, we've started to hump over, started to come down, started to hump over. Now could do something where it comes down like this until about maybe the year 2024, 2025. And so this is the basis of the whole video, that now in value, not in dollars, just in value terms, how in purchasing power, what has your dollars done in value? And I see a top sometime in 2000, with 2009 being an A, maybe 2018, 2019 being a B, and coming into maybe 20, an A and a C are usually similar. And so if this was 9 years, if this is another 9, that'd bring us down into about maybe the year 2027. But I see us probably coming down into a C wave, or like I said earlier, you could treat it like it's an ABC with a 1, or an ABC with a 1, or an A, B with a C. And the C, because of all the money printing. So I see something like this, but either way, whether you're looking at it as a wave 2 or a C wave, I think in value it's a C wave. In dollars, it's probably more going to be like a wave 2. And so here's another thing too that has gotten me, I wouldn't say worried, because if you position yourself correctly, like in crypto or silver and gold, then, you know, they can print as much money as they want. And cryptos and silver and gold are going to, they're going to reflect how much money is printed, and they're gonna catch up with it. Gold goes through an accounting phase where it is going to catch up with all the debt and all the money that's printed. This is what it does. And so we got a savings and loan crisis. Now, this was like in I think the late 80s or the early 90s. And so from there, I think it might have ended maybe in 95 to, this was 2000, but 2009 would have been the next bailout. But this ended up being like a $600 or $700 million bailout. And so hundreds, thousands, millions. Now we got the 2009 QE bailouts. Hundreds, thousands, millions, billions. It was like 700 billion. I really believe, now I know this is just unbelievable, but you figure hundreds, thousands, millions, billions, trillions, there's a good possibility, you know, sequences usually happen in threes. And I think it's a good possibility. We could see an $800 trillion bailout. The difference from this being, let's just say what, I don't know, 95 to 2009. What is that, about 14, 15 years? Go forward another 14, 15 years. What does that get us into? 2023, 2024, 2025? It kind of works in the sequence. If you figure early 90s to 2009, then add another 14, 15, 16 years in the sequence. And there is a $210 trillion liability out there that's floating around. This is a really good article. And you add a few, you know, if this is just the government, if this is just their liability, well, then what's the private sector's liability? You know, what is all those other pension liabilities that are out there that we don't know about? What if they're the same? Well, that would be 400 trillion. Now you only need a few other things, and we wouldn't be that far off from an $800 trillion bailout, or whatever it is, QE injection, however this ends up being. And so that's why I don't see a really good 4, 5, 6 years ahead in the dollar market, in the currency markets. There's just a lot of things that are pointing to probably some rough times ahead. And I could always be wrong. Take everything I say with a grain of salt. But we are also in you can compare a lot of things to where we're at right now. There's 7 stages of an empire, 8 stages. I've also heard 10 stages. And I believe that we're somewhere around this. And so this is kind of something similar to what most cycles of empires go through. This would be the pioneers, then they conquest, they build cities and towns, and they commerce, then they get affluent. This could be when the pioneers came, 1700s, 1800s, 1900s, maybe the early 2000s. And so I believe this is the next stage in the empire, and silver and gold do particularly well. Now, crypto has never existed in the history of the world, but I don't know how it's going to do. So, you know, it's just something we have to see. But I know I'm definitely a silver and gold bug. I have been for a while now, for probably about, I don't know, 6 or 7 years, since about 2012, 2013. And so I knew it was going to be a long one. So that's about it for today. I don't want to keep going on. This has already been a lot of stuff, but that's about where I see things going. That's my outtake on things. And so If you like the video, feel free to like, share, comment, and subscribe. I want to thank you for coming over to Blockchain Silver. And remember to stay safe out there.